This is the MOJO, the Meaning of Life and Business podcast, where life and business intersect. Hosted by Jennifer Glass, CEO of Business Growth Strategies International and BGSI Coaching. We are dedicated to your success. Hello and welcome to another episode of MOJO, the Meaning of Life and Business. One of the things that a lot of business owners at some point in the process of operating your business, you are going to be thinking about is, how do you exit the business? What do you do when you don't want to be doing the business anymore? Do your kids want it? Do you want to sell it? Do you want to just walk away? There's a lot of different things that you can be doing in the process, but a lot of it is going to come down to, first of all, who is helping you make that decision and what else may be behind that decision and where you go forward from here. And so I have a really interesting guest on the show today who's going to help us break down a little bit more about why you really need to be thinking a little more strategically about how you are going to be leaving the business. And if you're looking at selling, how do you maximize the value that you can get on your baby? Before I bring my guest on, though, let me tell you a little bit about him. Cameron Bishop is a distinguished executive and entrepreneur with a remarkable track record of transforming companies and maximizing value for business owners. Mr. Bishop has extensive experience advising private company owners on exit strategies and business transitions, and as CEO of SkillPath Seminars, he spearheaded significant organizational transformation. He is passionate about empowering business leaders to achieve their full potential and navigate complex challenges. Cameron, welcome to the show.
Jennifer, thanks so much for having me.
Absolutely. Thank you. So Cameron, let me ask you, before we dive into the topic, how do you get into the space of helping people sell their business?
Oh, that's a great question. My career path, which I'll be brief on, is not typical for someone who is an investment banker. I started my career as an advertising copywriter out of journalism school. And I grew up in a company that was acquired a couple of times, and the owners liked our business. It was technical publishing. And I said, go buy companies. So we just started buying companies. And you learn on the job that way. And over time, we built a business from 7 million to 400 million. I ran that company for the last 2 or 3 years, wrote a business plan after that, and partnered with JP Morgan Chase Bank's private equity group and built another one from my kitchen table to about 120 million. And over that time, I acquired about 50 companies, spent about $500 million of private equity money to do that. And to buy one company, which is a very difficult thing, I probably looked at 500 businesses. And you begin to see patterns in these companies where business owners don't know what to do to get their company ready for sale. They don't know how to sell it. And oftentimes it's either unsellable or they leave a lot of money on the table. As a buyer, it wasn't my job to tell them that they could have gotten a lot more if they had just taken certain steps. So I spent 5 years as a partner in a boutique consulting firm doing exit and transition planning to help those owners. I have a real passion for this. And then I did the turnaround at SkillPath, business transformation, ended during COVID. I don't sit easily. I get bored easily. And I said, I need to do something different. I love buying and selling companies. And I found a great firm that I've been with now for 5 years, a firm called Raincatcher, lower middle market investment firm based out of Denver. And I'm a partner and a managing director there. And we help business owners and family-owned businesses at the time they decide it's time to sell.
Thank you. And that's really an interesting story, how you started in copywriting and ended up in the investment advising space, which is definitely, like you said, an unusual trajectory to where you are today. So very interesting. Let me ask you, Cameron, because I'm sure one of the questions that some people are going to be having in their mind as we're having this conversation, because again, you mentioned the investment side. Is there a difference between the I'm going to ask for somebody to invest in my business with the hope that eventually I'm going to exit with an IPO or whatever it may be, as opposed to somebody is coming in right now and they're looking at just buying 100% of my business, whether it's seller financed or they're outright buying it, however it may work. Is there a difference there, just that we're clear laying that expectation for what we're talking about?
Sure, great question, Jennifer. Some of that depends on the size and nature of the company. And by size, I'm referring to revenue and profitability. When I was in the consulting world, and even today, I still get folks who contact me who have a business and they don't have all of the capital they need. And that if they could get it, they could grow it much, much faster. So they're looking for an investment in their company as opposed to an outright sale of the company. And that is typically very difficult to get that kind of money. And the smaller amount they're asking for, the more difficult it is. Usually on smaller scale, if somebody's going to invest in a business, it's usually what we refer to as friends or family money. In some cases, they may be able to tie it in with an SBA loan to finance growth in their company. Or if they're in some kind of a business, usually high tech or maybe some healthcare industries that have exponential growth potential, they may be able to attract investors at that time. But there's a crazy phenomenon in the investing world where it's far easier to get a whole lot of money than it is to get a little money. Because for the people who invest, it's the same amount of work to loan somebody $1 million pretty much as it is $100 million. Now, the business has to be able to support that and it has to be justified. But that is the general rule of thumb in the investment world where people just want access to some money. I know a guy who was got a huge order in the food industry, but he didn't have enough money to go out and buy all the raw materials he needed to manufacture the baked goods that he was creating. It was a catch-22. If he couldn't get the money to get the raw goods to make the baked goods, then he couldn't sell the baked goods to a very high-profile, financially stable grocery store chain. So that's the kind of scenario where business owners often look for an investment, but not an outright sale.
Right, and we see a lot of that on Shark Tank as an example, where businesses are going asking for that investment just that they can fulfill the purchase orders, things along those lines, and giving up the equity in the business just to finance that. And I will say though, it's really funny you mentioned the 1 million, $100 million investment in a business, because at the very, actually not at the beginning of COVID, right before we went into lockdown, business partner and I, actually two business partners and I, we were pitching a VC and we were asking for $1 million for our program that we were going to be putting out there. And this investor happened to just close a $500 million deal like within the last month. And he turns to us and he said, it's a rounding error, the $1 million. It's like, really, we go through all of this. We come up with all the projections, all the numbers, all of these different pieces of information that an investor can possibly want. And it's just a rounding. And that was
Yeah.
really an interesting thing. So brings me then to my next question. When we're looking at that amount that we're looking for, how do we avoid being told it's just a rounding error?
Well, if I had the answer to that question, I could probably be very wealthy helping people through that scenario. Because, again, besides the fact that it's, as I mentioned earlier, about as much and sometimes more work to loan a little bit of money, it's also typically higher risk money because in small companies, they have very little margin for error. Whereas at a big company that's making a ton of profit, yeah, there's potentially a lot more to use. But at the same time, you could have a downturn and still weather that downturn because you have the cash flow, the revenue, and generally the EBITDA profits in order to weather that storm and give you cushioning until the market picks back up again. So those are just key criteria. There are some small groups that will loan small amounts of money, but they're pretty few and far between, and they're usually pretty particular.
Right. Thank you. So let me ask you, Cameron, as we move forward from here. So somebody is looking at getting their business ready for sale. And we did, for those of you that have been listening for a long time, you know that a couple of years ago, we did have another business broker that was on the show. But as far as where we're going right now, we're seeing if there's maybe something different or something else you can learn. And if you haven't heard that other episode, definitely Cameron is great for us to talk about with here. So, Cameron, with that out of the way, if we're looking at getting ready to sell the business, right? And you said that you work with businesses to do exit and transitional planning so that they
Right.
are getting ready to know what they need to do, how they can maximize their value. And traditionally, from what we hear, it's anywhere from 2 to 5 years to really start planning on selling the business. Is that the same guidance that you would give to somebody today that you started speaking with, or is it a different timeline?
Uh, we uh, feel extremely fortunate when a business owner contacts us about selling, and they have actually even thought about preparing their business for sale. So your question is the correct one. In a perfect world, 5 years is the best possible scenario, but we'd be happy a lot of times with a year of planning. And sadly, most business owners reach a point of frustration and they say, "That's it, I'm done. It's time to sell." And they wake up one morning and they want to sell the business. They have done no planning to prepare the business for sale, and they frankly most times would have no idea what to do. But the kind of the key axiom here is that the typical business owner runs his or her company for revenue generation, tax avoidance, legal tax avoidance by utilizing the tax codes properly in their business, and for the profits or distributions that come out of the business because that's their primary source of income. So they spend 95 to 100% of their time working in their business. And if they're lucky, 5% of the time actually working on the business. And that's where the preparations need to occur in order to optimize the ability to sell the company and get the best possible price. And there are different management tactics used to prepare a business for sale and run it for maximum valuation on exit versus, as I mentioned earlier, revenue, tax avoidance, and distributions that they take home at the end of the year.
Thank you. And one other question as we're laying the groundwork in our conversation, is there a difference between the legal organizational structuring of the business? In other words, obviously a sole proprietorship is a different story, but LLC, S Corp, C Corp, any of that that makes a difference in terms of the sellability of the business?
Great question, and it's a very complex answer to that. So I'm not a lawyer, so I can't give 100%, but I can tell you that generally speaking, and there's exceptions to every rule, most businesses are better off as either an S corp or an LLC structure because it's simpler in most cases for the company to be sold, and it can be sold on, again, most cases on an asset basis as opposed to a stock basis. And virtually all C corporations need to be sold using the company's stock rather than just its assets. And there are a lot of tax complexities that can occur around a stock sale in a C corporation. But again, there's many exceptions to those rules, and the best bet is to seek an expert lawyer, usually in the beginning if you're just setting up a company, or if you're thinking about selling sometime soon, talk to them. So, for example, if you're a C corporation right now and a lawyer or a tax accountant tells you that that's going to be a disadvantage to you in terms of the tax hit that you're going to take, and they say, why don't you change to an LLC or an S corporation? You could do that. But the federal government has, I believe it's currently still a 5 year look back. So if you change from a C Corp to an LLC today, and 2 years from now you want to sell, the IRS is going to look at you as a C Corp for tax purposes. So it's a long term play, very strategic, best to get professional advice from tax accountants, CPAs, or lawyers.
Absolutely. Thank you. So let's move on because one of the things you mentioned was different managerial ways that we can look at that transition. And you mentioned as an example, one of them was simply looking at how do you look at the finances of the business, right? We said right now you're taking those distributions, you're maximizing your tax benefits and things along those lines. So that's the financial management of the business. But what other kinds of focus do we need to think about? Is it key people? Is it competitive advantages that we need to look at, innovation that we need to look at? What are some of those other aspects that maybe a business owner should be thinking about as they're thinking in their mind to even come to you, Cameron, a year down the road instead of, oh my God, I had it, I want out right now. Anything in that time, or even once they do start working with you and then having that lead time that they should be thinking about to help them be in a better position to sell?
Sure. Well, again, there could be some unique factors in any business, or some industries have some factors that other industries don't. But the key fundamental criteria that can help optimize exit value and inversely are the same things that oftentimes keep a company from being sellable at all, or are forced the business to be sold at a steep discount. So, first and foremost, is for the business owner to have a focus on high quality, accurate accounting that hopefully is accrual based accounting as opposed to cash based accounting. Because when a buyer buys a business, generally they're going to take out a bank loan or an SBA loan, and the banks all want to see the accounting done on an accrual basis. So, accurate, high quality financial reporting is factor number one that we see that helps streamline the sale process on the positive side, or can totally derail the ability of a company to sell on the negative side. The second factor, and this is one of those factors that relates to what I mentioned earlier about pre planning. There are different ways to think about the company if you're running it for valuation versus just how much of a distribution you can take at the end of the year. And buyers all want to know what the role of the owner of the company is. So it's called, their concern is what is referred to as owner dependency. So if the owner is a key source of critical knowledge in the business, especially if it's technical knowledge, and there's nobody else that is a backup there, that's a real red flag for buyers. If the owner is the key relationship person with customers, again, that's almost always a red flag for buyers. If there is no successor to the CEO, that's always a concern. And ironically, most business owners, when they decide to sell, they want to sell because they want to retire or get out of the business sometime soon. And buyers don't like that in most cases because of that owner dependency factor. So part of the deal structure is going to be that owner has to stay on for some negotiated period of time. It could be a year, it could be 2, 3, up to 5 years to mitigate risk that the buyer might see and to train a replacement for that owner. So if somebody is preparing to sell down the road, they have to invest in their business in the short term to get a greater value at the end by bringing on a successor to work for them. And of course, if they're paying another headcount, that's that much less distribution they get at the end of the year. And that's a key example of a difference between running a business for current profits versus running a business for optimum valuation.
Thank you. So here's an interesting question that popped into my head as you were mentioning the successor for the CEO. What happens in the event of a partnership where one partner wants out and he wants to sell the business? The other partner is not interested in buying the partner's half, or maybe they can't because they didn't get the insurance set up for the, insurance proceeds to buy out the partnership, whatever it may be. Do you ever run into those kinds of concerns? And if you have, how do you start to navigate? And again, we're talking therapy here too, but how do you start navigating those waters?
Yeah, that's actually a fairly common scenario, Jennifer. It occurs in family businesses and it occurs in partnerships. I had an interesting case study when I was consulting where there were three partners. One was in his 40s, one was in his 50s, and one was in his 60s. And this business was hugely profitable. And the owner in his 40s wanted to lean in and reinvest a lot of their profits into growing the business even further. The owner or the one of the partners in his 50s was less enthusiastic about that. And the partner in his 60s was dead set against it because, again, they were taking all these distributions as profit. And if you turn around and reinvest in growth, the owner partner in his 60s was saying, I'll never see a return on that investment. So we negotiated a compromise structure in that case. They didn't want to sell the whole company. They had different timetables and different strategies for what to do with the business or to grow it. In the case of two partners, one wants to sell and one doesn't. Again, depending on the size of the company, if they're large enough and profitable enough, and in any kind of an industry that is attracted to financial buyers, whether they're private equity, family offices, or what are called independent sponsors, oftentimes the company can be sold and the partner who wants to leave takes out 100% of his share of the business, and the partner who wants to stay does what we call rollover equity. So he retains an equity stake under the new ownership and at the same time can usually take what we refer to as take some chips off the table. So he can get a distribution of a sizable amount based on the valuation of the company, yet continue to run the business generally and be an equity holder in what is almost always a larger company. That if it's a private equity buyer, they're going to consolidate a number of companies, package them together, and generally in a 3 to 7 year period, they will resell it. And quite often, the equity that owner rolled over becomes worth more than the portion of the business he sold to that buyer. So he gets what's referred to as a second bite of the apple. So it can be a real win-win in most cases.
Right, and that's really interesting to get that second bite of the apple and with that win-win situation. Really an interesting idea in that regard. So, Cameron, let me ask you, what other common mistakes have you seen business owners make as they are preparing to sell their business?
Yeah. Well, this is one that is a real non-starter for a lot of buyers. And another reason why business owners should really begin to think about their exit years before they plan to exit. And that's the third criteria we look at, and that's called customer dependency. So when we are representing a business owner and we market their company, we put together a target list of potential buyers. Could be 100, could be 400 or 500. Strategic buyers, family offices, private equity firms, independent sponsors, search fund buyers that might be interested in that company, and we will market to them, have them sign an NDA, and we are very hands-on in protecting our clients. We kind of jokingly call it Match.com because we try to find buyers who will pay an optimum price for the business, have the most attractive deal terms and deal structure, and be a really comfortable fit as a buyer of the business for the seller of the company. So we kind of refer to that as Match.com role for us. But when we're talking to these buyers, to interested buyers, to vet them, the first question we always get is why does he going to want to sell? And the second question we get is what percentage of total revenue is represented from their largest customer? And the key factor is that most buyers will walk away if a customer represents more than 20% of total revenue. And that's why if a business owner understands that and they look at their mix of customers, if they've got somebody at 30, 40, 50%, they're probably not going to be sellable, or they're going to take a steep discount because the buyer is going to see that as a huge risk factor, or they're going to get a very unattractive deal structure, again, to reflect risk mitigation. So a very quick, simple example, I was representing the owner of a very creative gentleman in the state of Michigan who had a combination marketing agency and premiums and incentives business. He won all kinds of awards. So he checked the first box that he had heavy owner dependency. He missed the second box. He had no successor. But most importantly, he had a large medical chain that had like 50 locations that represented 50% of his business. And his argument was, well, it's all one company name, but I have to sell to each one of those 50 locations. Well, buyers, none of them would pay him any, right? We got 6 offers for his business, but none of them would pay him cash on closing. There were 3-year earnouts, 2-year earnouts, and they were going to pay him almost the full value based on how the business performed over the next 2 or 3 years. And he was going to have to stay on as an employee for that time period. And he got upset and he walked away from everything. I stayed in touch with him, really good guy. 6 months later, that large medical chain got a new senior executive, and as often happens, they brought in their own vendors, and he lost 50% of his business, and he was completely unsellable at that point. So that's why buyers of companies are so sensitive about how big the contribution of any one customer is to total revenue.
So let me ask a follow-up on that. If your top 3 customers are in the... So again, Cameron, if we're looking at the top 3 customers potentially being 50% of the revenue, you mentioned the 20% number being that golden ratio, if you will, under that. Will the top 3 being 50% of the revenue impact the business's ability to sell too? Or is that not mitigating the risk enough with the top 3 accounting for such a huge chunk of the business?
Generally, it's going to be an impediment to selling, or the other scenarios I mentioned earlier might come into play. And I've seen cases where a strategic buyer was going to buy a company and they weren't concerned about the customer concentration because they were a much bigger company, and the 20% or greater contribution to revenues in the business being acquired doesn't become a factor because the math works and it's much less of a contribution. Yeah, generally, the buyers, ironically, buyers are taking on risk or accepting risk in making an acquisition, but at the same time, they are equally risk averse. And so they're all looking for these risk factors as they see them.
Right. And it's so important, like you said, what is that risk factor that's going to be potentially being that red flag to their mind that'll say, no, let's stay away from this. It's not going to fly because there's just way too many dangerous points there. So if we're looking at the timing, so we said at least 1 year out is where we want to start thinking, how do we start seeing what changes we're making in the business? We said that we need to look at the organizational structures, that from a tax perspective, it's going to be best sold on the asset level as opposed to the stock level for tax purposes and things along those lines, which again goes back to that 5 year look back point of whatever the tax structure may be and your taxing authority that can be making a change there. We spoke about some of those concerns about the buyer concentration and the successors in the business, things along those lines for the CEO. Are there other major red flag issues on both the seller and the buyer side that we would be remiss if we didn't say, at least think about this now?
Yeah, so I don't think it's a surprise that most buyers want to see a company that is growing in both revenue and in profitability. If a business is stagnant or declining, those are certainly detractors from a company either selling or selling at an optimum valuation. Similarly, buyers want to look at what the gross profit margins are of companies. So that's basically revenue minus their cost of goods, raw materials, etc. And what that gross profit margin is, the percentage. And every industry has a different percentage, and they benchmark against what the typical gross profit margins are in that particular industry. And there needs to be a focus on getting that to at least market norms if they aren't there. And again, that's something that almost always takes a runway of time to make changes, whether it's renegotiating materials contracts or figuring out how to reduce manufacturing costs if that's where the issues are. So that's one key aspect of it: growth and profit margins, and similarly, EBITDA profit margins, because companies with $1 million or more in EBITDA profits are generally, the valuation is a multiple of their adjusted EBITDA profits. And those multiples can vary by industry, and they can certainly be discounted or driven to a premium depending on a lot of the other characteristics of the company.
Thank you. So, an interesting question came to mind as you were talking about the profitability of the business. And that question is, if I am right now, let's just say as an example, I have $1 million in revenue and I have $500,000 in profit. But last year I had $1 million in revenue and only $200,000 of that was profit. So I am increasing the profit on the revenue that we're generating because we're cutting back expenses, cutting suppliers, or using AI more in the business, whatever it may be. Is that going to potentially get me a better valuation because I've cut the expenses against the business and increasing profitability? Or is that looked on in the same regard?
Generally, that's going to be an attractive characteristic of the business. However, most buyers are going to want to see some ongoing performance to see if that is sustainable. So, a lot of times, a business owner thinks he or she could get a better value for the company by let's say they spend $100,000 a year on advertising, and if they're in an industry where the multiple of EBITDA profits is four times profits, and if they eliminate $100,000 worth of expenses, then they've theoretically created $400,000 of exit enterprise value for the company. But buyers are either going to see through that and say, well, you're just trying to window dress your profitability, and they're going to make their own adjustments and add that back, or they're going to want to see a year or 2 years or maybe 3 years of ongoing performance without that $100,000 expense to see that the company can continue to perform at least the same level, if not continue to grow, and that expense they cut out isn't detracting from the company's ability to grow.
Thank you. So we looked at a lot of the aspects of getting a business to be sellable and maximizing the valuation that the business gets. We looked at a lot of the reasons why some of the businesses may think they can get more, but in reality, they're going to be getting less unless they are working with somebody like you in that exit transitional process and really understanding what it is that they need to be doing and going from there in order to be helping them get to that next level. Anything else that we need to really hit home in that area?
I think we're pretty good there, but I think it's also helpful and for your listeners to understand that, again, if they're thinking, "Oh my gosh, I'm not going to be able to sell for another year, 2 years, 3 years, whatever," to do the planning work. And as I mentioned earlier, we see so many cases where an owner gets frustrated, calls us and says, "Okay, I want to sell." Unfortunately, they want instant gratification, and in almost all cases, it's just not going to happen. The national average, regardless of the size of the company or the industry, from the time a business owner signs an engagement letter with a business broker or an investment banker to represent them, it's a 9 to 10 month process before the sale closes and a wire transfer hits their bank account. And they just don't understand that. It's also, I try to encourage them to understand and manage expectations that selling a company is an extremely complicated, difficult process. For the business owner, it is literally a full-time job on top of a full-time job running their daily business for a good portion of that 9 months. It's also an emotional roller coaster ride. It can be extremely stressful. And, and our role as investment bankers, almost half of what we do is to kind of symbolically hold our clients' hands, keep them encouraged, give them perspective, because again, they're dealing with a lot of foreign concepts. And, most of these business owners, this is their baby for their careers. They eat, sleep, and breathe it. Could be even more so if it's a second or third generation family business. And, it's difficult for these owners if somebody calls their baby ugly. And, we're the intermediary in there to help provide perspective on that and, just to keep them encouraged through the process. Sometimes owners get so stressed out they can become their own worst enemy and cause a deal to blow up, which is not in their best interest. So it's an important role. When I was running companies, my theory was know what you know how to do well and do it. Know what you don't know how to do well and hire an expert to do it for you. And that's where a sound professional who knows how to represent business owners when they sell is critical. We encourage them to hire M&A attorneys who have proven experience in M&A and transactions as opposed to like a general business attorney. Or I had a case where the owner was represented by a divorce attorney and it was a nightmare because they just didn't understand the process. So, and we help our clients, we quarterback it. We we help surround them with the experts that they need to both protect them and to give them the best possible advice.
So I'm going to just throw out the question. I'm sure the answer is going to be a resounding no way. Can I use AI to just do this whole process?
Well, I think the sky is the limit for AI. We've adapted or adopted some AI applications in our own firm, mostly to help us source leads on business owners who might be at a point in time where they want to sell, but also to help gather industry information so we can be even greater experts on the industries that where we have clients that we're representing. I suppose anything's possible there, but it's such a challenging process. And there are so many complicating factors like around if a business owner doesn't understand balance sheets, net working capital, they could leave a lot of money on the table and never even realize it. Now, maybe someday AI will be able to factor all that, but it's also going to be a factor. You got to find buyers, and that's not an easy thing. Buying and selling companies, it, not trying to toot my own horn, it's just hard work, and it takes a long time. It's often a needle in a haystack.
Absolutely. Thank you. And like you said, it's so important. Remember what AI can do, what it can't do. It can't hold your hand. It can't really give you the years of advice that comes with experience, things along those lines. Like you said, someday it may be able to actually do more of that, but right now, at least, it's not capable of it. And so you definitely want to be reaching out to Cameron. So, Cameron, let me ask you, people have been listening to our conversation for the last 45 or so minutes. How can they get more information about you?
I'd love to chat with any of your podcast listeners. Again, my name is Cameron Bishop. My email is cameron.bishop@raincatcher.com. And our firm website is www.raincatcher.com. And I'm also easily found on LinkedIn. Happy to have a conversation with anybody. No cost, no obligation, and I promise no sales pitch because we feel like it's just flat unethical to try to talk a business owner into selling his or her company unless they come to us and say, I want to sell. I actually talk a lot of people out of selling, or at least selling now, because I see issues that are either going to make the process unsellable or sell at much of a discount. So please reach out. Happy to chat.
Thank you. And again, we'll include all that information in the show notes and description for the episode so that you can reach out to Cameron and learn more about is it the right time or not the right time to sell your business? And if it is, what else do you need to be looking at to get there? So, Cameron, thank you so much for being my guest on the show today.
You betcha. It's been my pleasure. Thank you for having me.
Absolutely. Thank you. And the biggest takeaway really is going to be look at what it is that you are doing in your business. Do you have any of those warning signs that Cameron mentioned? Are you the only person in the business that everyone is dependent on? Do you have more than 20% coming from your biggest client? All of these different aspects are certainly important to be looking at in your business. And if they are in your business, these warning signs, start thinking about how do you diversify so that that is not going to be a warning sign when the time does come. And certainly reach out to somebody like Cameron who can help you guide through that process, walk you through what do you need to know, how do you need to do it, and how long is it going to take. And again, remember, it is going to take almost a year from start to finish if you really have all of your ducks in a row to sell your business. It is not I go online, I press a button, and it's sold. There's a lot that happens in that time, and a buyer needs to be found, just like selling a home. Sometimes you get really lucky, buyer comes in, they say, I'm ready to buy right now. Other times, a house can sit on the market for a while. Your business is going to be the same. Sometimes you're going to get a little bit better. If all of this stuff is there, everything checks out, you may sell quick. Other times it can be much longer. Just be prepared for that in what it is that you are doing and what that means for you, your family, your team, and your clients. Because at the end of the day, all of you are stakeholders in this process. So again, Cameron, thank you. And on that note, this has been another episode of MOJO, the meaning of life and business. And until next time, here is to your success. This has been another episode of MOJO, the meaning of life and business podcast. If you like what you heard, please consider leaving us a review, liking us, or reaching out to us. You can contact us at bgsicoaching.com and let us know what you think. Thanks so much again for listening.